The mortgage industry of the United States is the major financial sector. The federal government created several programs, government-sponsored entities to foster mortgage lending, construction, and encourage home ownership. What is the mortgage types, how they work, and examples? A mortgage is a type of loan used to purchase or maintain a home, plot of land, or other type of real estate. The borrower agreed to pay the lender over time, typically in a series of the regular payment that are divided into a principal and interest. The property then serve as collateral to secure the loan. A borrower must apply for a mortgage through their preferred lender and ensure that they meet several requirements including minimum credit score and down payments. Mortgage applications go through a rigorous underwriting process before they reach the closing phase. Mortgage types such as a conventional or a fixed rate loans vary based on the needs of the borrower. Mortgage are loans that are used to buy home and other type of the real estate. The property itself serve as collateral for the loan. Mortgage are available in a variety of types including fixed rate and adjustable rate. The cost of the mortgage will depend on the type of loan, the term such as 30 years, and the interest rate that the lender charges. Mortgage rates can vary widely depending on the type of product and the qualification of the applicant. How mortgage work? Individual and businesses use mortgage to buy real estate without paying the entire purchase price upfront. The borrower repay the loan plus interest over a specified number of the years until they own the property free and clear. Most traditional mortgage are fully amortizing. They mean that our regular payment amount will stay the same, but different properties of the principal as interest will be paid over the life of the loan with each payment. Typical mortgage term are for 15 to 30 years. Mortgage are also known as a lines against property or claims on property. The borrower stop paying the mortgage, the lender can foreclose on the property. For example, a residential home buyer pledges their home to the lender, which then has a claim on the property. Ensure the lender interest in the property should be by default on their financial obligation. In the case of the foreclosure, foreclosure, the lender may evict the resident, sell the property, and use the money from the sale to pay off the mortgage debt. The mortgage process would be borrower being the process by the applying on one or more mortgage lenders. The lender will ask for the evidence that the borrower is capable of paying the loan. This may include bank and investment statement, recent tax returns, and proof of current employment. The lender will generally run a credit check as well. If the application is approved, the lender will offer the borrower a loan of up to a certain amount and at a particular interest rate. Home buyers can apply for a mortgage after they have chosen a property to buy or even while they are still shopping for one. Thanks to a process known as a pre-approval, being pre-approved for a mortgage can give buyer an edge in a tight housing market because sellers will know that they have the money to back up their offer. Once a buyer and seller agree on the term of their deal, they or their representative will meet and what called a closing. This is when the borrower make their own payment to the lender. The seller will transfer ownership of the property to the buyer and receiver they agree upon sum of the money and the buyer will sign any remaining mortgage documents. The lender may charge fee for the loan at the closing. Mortgage comes in a variety of forms. The most common type are 30 years and 15 years fixed rate mortgage. Some mortgage terms are as short as 5 years, while other can run 40 years or longer. Stretching payments over more years may reduce the monthly payment, but it also increases the total amount of the interest that the borrower pay over the life of the loan.